Today we have some fascinating insights from the esteemed market expert Jeremy Grantham. He recently shared his thoughts on current market conditions and showed us what he predicts for the upcoming week. So let's dive into what Grantham had to say. Grantham firmly believes that we are currently in a market bubble. However, what's intriguing is that he thinks this bubble differs from any we've seen in history. You see, during past bubbles, like the bubble of 1929 or the tech bubble of the late 90s, investors would take a thriving economic situation and extrapolate it into the future, assuming it would last indefinitely. But not this time. Grantham highlights that our current conditions are unique and unprecedented. We are witnessing the highest 5% of price to earnings, or PE ratios, meaning stocks are priced quite high relative to their earnings. Additionally, Grantham points out another crucial aspect of the current market situation. He highlights that governments worldwide actively seek their central bank support to drive their respective economies forward. This has created an enormous push in the market, and history has shown that it can be incredibly effective at influencing stock prices. Grantham draws a fascinating analogy comparing money flow to water taking the path of least resistance. Every dollar not absorbed by the real world, such as investments in productive industries or creating jobs, tends to flow effortlessly into asset pricing. As a result, we witness a price surge in various assets like stocks and houses. This may seem impressive for the stock market, and it has been driving stock prices higher. However, Grantham warns that this situation might not be as beneficial for the broader real economy. The struggle between the paper world of PE ratios, house prices, and the real world of productivity, employment, and GDP is quite evident. Now, here's where it gets even more intriguing. Grantham describes the current economic situation as a novel economy, much like the novel virus we've all experienced. Our confidence in predicting their outcomes was relatively high in previous bubbles because historical patterns and forces repeat themselves. But this time things are different and much less certain due to the unique forces at play. Grantham believes that reality will eventually catch up with the high PE ratios. When you buy overpriced assets, you may not be guaranteed a high return, but you also don't have an immediate guarantee of being wiped out. Timing the breaking of a bubble becomes challenging when all assets are overpriced, whether it's at 25 times earnings or 35 times earnings, or even as high as 65 times earnings in Japan. Instead of solely focusing on specific valuations, Grantham prefers to look for signs of truly crazy behavior in the market. He parallels past bubbles that spectacularly crashed, often preceded by legendary stories of craziness in the market. These signs of excessive speculation and mania have been present in the past before major bubble bursts. Grantham points to examples like the recent surge in certain stocks, with some companies on the brink of bankruptcy, yet experiencing skyrocketing prices. The rise of SPACs, special purpose acquisition companies, also echoes the speculative nature of previous bubbles. While he's not suggesting that all such investments are fraudulent, he sees these events as indicators of a market potentially reaching a late-stage bubble. Historically, similar signs of irrational exuberance were prevalent before the crash of early 2000 and late 1929, and during Japan's bubble. Grantham admits that historically the Fed has often emerged victorious in its attempts to sustain the market. However, there have been instances where the Fed has been knocked out, eventually unable to keep certain bubbles going indefinitely. He cites the example of the tech bubble, in which the Fed managed to push up to a PE ratio of 35 but couldn't go on forever. Even in Japan, where the bubble reached a PE ratio of 65, it ultimately crashed when knocked out. However, Grantham provides a word of caution for long-term investors. While he advises against fighting the Fed for short-term players, he believes that long-term investors must be prepared to stand their ground on occasion, especially when facing a slowing global economy. Kicking in massive government stimulus becomes necessary. Looking at past examples such as Japan's real estate bubble, which he considers one of the biggest bubbles in history, it took around 30 years to bottom out, and prices are still nowhere near the levels they once were. Such situations underscore the importance of strategic decision-making for long-term investors. Grantham also reflects on a debate with Jim Graham a few years ago, where Graham called him an apostate among value managers. At that time, Grantham firmly believed that the four most dangerous words in investing were This time is different. He argued that these words should be replaced with the 5 most dangerous words. This time is never different. Grantham explains that believing nothing will change can lead to a dangerous complacency, as almost everything has changed since 2000. He acknowledges that over the years, certainties we relied upon no longer hold in the ever-evolving investment landscape. However, recent events have brought even more dramatic shifts, particularly with the massive move against value stocks like VEMA, which have reached historical lows against growth levels. Grantham concedes that while value investing may not be as dependable and useful a weapon as it was in the 70 years before 2000, it still retains its importance. When pushed to historical lows against growth, value investing becomes a potent weapon again. While he admits that we may not experience the same snapback to previous levels that one would have calculated 20 years ago, he firmly believes that a significant reversal in favor of value stocks will occur sooner or later. Grantham's advice on the current investment landscape is quite intriguing. While he doesn't necessarily recommend going short, he does advise owning as few US equities as possible. Instead, he suggests focusing on emerging equities, as they are not only at an unprecedented low relative to US equities, but are also quite cheap in absolute terms when compared individually. The emerging markets are represented primarily by 3 major players: China, which is projected to contribute over 30% of the world's growth in the next 2 decades, India, an increasingly important player, and Brazil. Collectively, these emerging economies make up a significant portion of the global GDP and are expected to experience rapid growth. Grantham believes investing in emerging markets is akin to betting on the future against the past. On the other hand, he finds the FANG stocks, that is, Facebook, Apple, Amazon, Netflix, and Google stocks, intellectually interesting but not necessarily financially interesting, especially when their valuations have surged tenfold in a short period. Grantham advises against shorting the FANG stocks and growth stocks in general because shorting can be an incredibly challenging game. There's always a risk that these stocks may put in one last push, shaking investors loose and causing significant losses. Instead, he emphasizes that when done correctly, government spending can be very beneficial for the economy and workers. In the US, real hourly wages have stagnated since the mid-1970s. Contrasting that with Europe, where wages have more than doubled, and countries like China and Vietnam, where wages have increased tenfold, it becomes clear that government spending can have a positive impact. Grantham questions the hesitancy of some investors when they have such a promising opportunity. Emerging markets encompass 26 countries and span every industry, providing a diverse and robust investment landscape. As he expresses his concern about America, Grantham humorously remarks that while the country is exceptional, it has become exceptionally bad in various social and health measures. As investors, it's essential to carefully evaluate the potential of emerging markets and remain pragmatic in our approach to investing. If you found this video helpful, don't forget to hit the like button and subscribe to our channel for more insightful updates. Also, don't forget to share your thoughts in the comment section below. Until next time, take care and happy investing.